Let's talk about this affordability squeeze going on in the housing market right now. Not new news, but we are going to take a further look at that today. Plus, there are some areas of the country that are getting hit harder than others in terms of buyer activity in the housing market, and a new prediction on when we will see home prices come back to normal. So let's get into it. Obviously, I sound a little off today. I promise I'm feeling okay. I just am getting over a cold and sound terrible. So my apologies. Let's start with this info here. Middle class struggling to afford housing once firmly in its grasp. Rental costs have also climbed sharply. So this article is not only talking about home prices, but also talking about rental rates and how housing in general has really become a challenge and quite unaffordable to many people, in particular the middle class. They're saying that the analysis of 390 metro areas found that nearly 1/3 now require double the income needed just 6 years ago in order to purchase a home. And nearly half require six-figure salaries to afford a typical priced home. Now, rental costs have also climbed sharply since 2019. 47% of tracked occupations cannot afford a two-bedroom apartment, with dozens of metro areas requiring salaries above $75,000 for such rentals. Now, they call out a number of metro areas. None of these are actually based in Arizona, and I know that's mostly where we focus on, but these are good things to note whether you're in any of these areas or considering a move there. Asheville, Boise, Houston, Tampa, and Seattle. So not really new or surprising news on that front, but looking specifically at the middle class in that situation. Now, this article from Housing Wire is talking about Gen Z, specifically its thoughts on the renter versus homeowner debate, as well as affordability in this. More than half of respondents say mortgage rates are a key home buying hurdle. And I know that much of the feedback that I get on this channel is that it's prices, it's not rates, but there are a big group of people that are very much focused on rates, whether you like it or not, whether you believe in it or not. There's a number of people out there that are buying based on mortgage rate. And so the higher rates and or the fluctuations really keep them away from the market. Gen Z being a big portion of that. Now, this article is citing rising mortgage rates, high home prices, student debt, and career uncertainty being those factors that are kind of shaping the perspective of this generation in terms of being homeowners or not. And many have decided to rent for the long term. They say the biggest homeownership obstacles for Gen Z is rising mortgage rates for 57%, escalating home prices 52%, student loan debt 38%, and career instability 40%. Roughly 1 in 3 renters said these costs and responsibilities were enough to steer them away from home ownership. Now, obviously, Gen Z is the youngest end of our generations that are of home buying age, but this does make us start to think, if they don't change their mindset, are they always going to be out of home ownership? And how will that affect our market going forward if we have an entire generation that is really not interested in buying? Now, as we all know, the pendulum kind of swings between renting being more affordable and buying being more affordable as the market changes over time. So perhaps their mindset will change as the market shifts. But for now, it seems that, renting offers them a little bit more flexibility. They aren't locked into a mortgage rate. However, as we just read about, the rental market isn't quite that affordable either. Now, I mentioned that there are particular areas of the country that are seeing a little bit more of a shift in the housing market than others. And in particular, we are talking about vacation towns. And one of our Phoenix metro cities has made this list. In vacation towns, home sales are falling and prices are stagnating. The number of homes sold in seasonal towns, those where vacation demand drives the housing market, fell 3% year over year in July. That's compared to a 1% decline in non-seasonal towns. Now, they say that seasonal towns are defined as those where more than 30% of the housing stock is used only seasonally or occasionally. Roughly 9% of all home sales in the U.S. are in seasonal towns. They say there are 288 seasonal towns throughout the U.S., and Scottsdale, Arizona is included in their analysis. Sales are declining faster in vacation destinations because they're often second homes or investment properties, which are typically the first to be cut when affordability is tight. Now, I will say there are a lot of homes in the Scottsdale area that have been purchased as investment properties properties, particularly for short-term rentals, that have now been listed on the market and aren't getting a whole lot of activity because there isn't a pool of investors as interested in short-term rental opportunities right now. They address that in this article. The short-term rental market is not as appealing as it once was. Purchasing a home to rent it out to tourists is less appealing than it used to be. The uncertain U.S. economy may mean short-term rentals get fewer bookings for less money. Tightened short-term rental regulations make it more time-consuming and difficult to manage a second home as a rental property. The vacation rental market is saturated in some places with heavy competition pushing down pricing. And I've seen a lot of that taking place in Scottsdale. They say overall the supply of homes for sale in seasonal towns is up 17% year over year. Now, with all of that going on with affordability, we have seen some pretty significant movement in mortgage rates, which I'm going to talk about in a little bit. But there was an article from Housing Wire that says lower mortgage rates pushed inventory lower in August, a rare event with our data in August lately. Now, Logan Motoshami is saying the results have surprised me. He says in recent years, it has typically taken sustained mortgage rates of around 6% to impact housing data. However, I noticed a shift starting in mid-June, and this trend has remained consistent for over 2 months. So basically what we saw was not only mortgage rates coming down and boosting a little bit of buyer demand, but we also saw inventory going lower at the same time. As I've shared before, the new listings data peaked in May and reached a total of 83,143 on a national level. Since then, the number has been gradually declining, and we usually don't see this peak in inventory until later in the year. So this will definitely be something to watch. It is rare that Logan Motoshami is surprised by data because he's usually pretty good at predicting what is coming forward based on historical trends. But this week is going to be a very interesting week because it is jobs week and loaded with a bunch of other economic news that could totally shift where mortgage rates are at. Now let's take a look at active listings throughout the Phoenix metro area and see if it's kind of matching that trend that he's been seeing. And we are still on this downward trend of active listings in the Phoenix market. I guess we've had a tiny little uptick from last week to this week. Nothing too significant at this point, but we've still been seeing this downward trend in active listings ever since the end of May. If you're curious about what the active listings look like in your city, check the description below. You can request that information. Now, I mentioned there is a prediction around when housing costs will return to normal. So let's talk about that. Before I get there, if any of this is helpful for you, consider subscribing and share this video with someone who would find it helpful. So U.S. housing costs to return to normal by 2030 with stable price growth and moderately lower rates. So that's another 4.5 years away. This is according to Redfin. They're saying this year the U.S. housing market has been described as a nightmare, very unusual and alarming, along with expletives we can't write, and with good reason. We've seen home prices near record highs, mortgage rates remain elevated, and not enough homes being built to meet demand in many areas of the country. So a glimmer of light. They're saying a return to normal by 2030 if home price growth stabilizes and mortgage rates fall to 5.5%. Okay, guys, I really don't know that mortgage rates are going to fall to 5.5%. I could be wrong. I hope we can replay this for me in a year and laugh about how I was wrong, but I don't know that I see 5.5% anytime very soon. So they're saying the path back to normal housing costs doesn't require a crash in home prices. Stability may be enough. Buyers shouldn't expect affordability to snap back overnight, but the trend lines point to real progress within this decade. So they are calling normal 2018. They're using that as the baseline. In July of 2018, mortgage rates were in the mid 4% range. Home prices were rising, but still relatively manageable. Number of buyers and sellers were relatively balanced. And the median monthly mortgage payment to income ratio had just reached 30%. Now, they're also saying normal doesn't necessarily mean affordable. So obviously, different areas of the country are a little bit different. In 2018, the monthly mortgage payment to income ratio was 74% in San Francisco. So very different than that 30% benchmark. And it was 18% in St. Louis. So across the country, things will look a little bit different. But they say they compare costs using two 30-year mortgage rates, 6.7% as an approximate representation of the past 3 months. And rate activity, and then 5.5% as a hypothetical level. And in order to get to this normal market, mortgage rates would have to fall to 5.5%, and annual household income growth stays at 3.9%. Home prices grow at current rates, which is 1.4% year over year. If they stay flat year over year, housing costs could return to normal by January of 2029. If they fall 2%, housing costs will return to normal by November of 27. And if they grow 2%, we're looking at 2032 before we see anything normal. Now, I think this is like really, really hard to predict. There are so many factors. Obviously, home price growth, home price decline, stability, mortgage rates, inflation, wage growth, any pending, economic change, war, who knows? This is really, really hard to say with any sort of certainty. But at this point, what we can say is we have seen softening in the housing market. We have seen prices coming down in a lot of areas. And if that trend continues, we may reach a little bit more of a normal market or a bit more affordability over the years, unless we do see a major market crash, which I know many of you are hoping for, and whether or not that's coming is anyone's guess. Now, if we take a look at where we're at with mortgage rates today, last week was like an incredible week in mortgage world because rates really didn't move much at all, which isn't very normal for rates. But we ended the week just right around 6.5%. Obviously, you can see this is a big change from even as recent as middle of July. And there just wasn't a whole lot of volatility last week. Now, they are warning us that this week could be quite volatile. Bottom line, to whatever extent it was unlikely that the outgoing week would see much volatility, the forthcoming week is likely to be just the opposite, for better or for worse. And why is that? We have a lot of economic news coming out this week. We've got some Fed commentary on Wednesday. On Thursday, we have the ADP employment report. Initial jobless claims comes out. A number of other pieces of commentary from the Fed presidents. And then Friday, we have the jobs report, wages, unemployment rate, all of that good stuff. So all of these things are potential market movers. So if you are, in the middle of getting quoted your mortgage rate, just know there could be some changes this week. Now, for anyone who is not interested in entertaining today's mortgage rates, there is that option for assumable mortgages. We have a few clients we're working with right now to purchase and sell homes with assumable mortgages. So check the description below for more information about that. The Cromford Market Index this week around 79.6. Not a major change from last week. Demand has gone up a little bit, 77. Supply is continuing to come down, 97. So there's still this gap of more supply than demand, but it has been coming closer together, which has been putting the market index a little bit higher and getting closer to a balanced market rather than a buyer's market, although we still have a ways to go on that. If we look at all of these major cities, again, a lot of green arrows. Month over month, there's been progress moving more towards a seller's market. We now have these 6 cities from Paradise Valley to Avondale in a seller's market. We've got a good chunk in balanced markets all the way to about Mesa, and then still a good number in the buyer's market from Peoria down to Maricopa. But overall, we are seeing this movement more towards a seller's market. Not a big change month over month percentage wise. This week it was a positive change of 9.4%, whereas last week was 9.3%. So that trend has slowed down a little bit this week, but we'll see what next week has to offer. We are finally in September, so we are getting into the fall officially, even though it never feels like fall here in Arizona for a few more months. But we will likely, in my guess, start to see inventory climb again. So we'll keep an eye on inventory. We're also seeing for the contract ratio that Overall, there's a little bit more green here, which indicates a balanced and warm market as compared to a lot more blue that we were seeing. So, this is back at the beginning of August. If I move this forward to the end of August, you can see there's a few more zip codes with green versus blue here. And the overall contract ratio is sitting at about 32.6, which is considered to be balanced warm across the market. So this is really measuring the number of listings available for sale and how many of those listings are actually already under contract. Thanks for bearing with me and this voice this week, you guys. Hopefully next week I will sound a little bit more normal. Check the description below for those resources that I mentioned, and I will see you all next week.